Investors and traders, welcome to the channel Market Chart Pattern. Today is 20th of July 2024. I hope everyone is having a great weekend. In this video, we'll be taking a look at the key US markets. In particular, we'll be taking a look at the US stock indices and also the bond markets and the US dollar. The markets have been very volatile. In fact, since the CPI print came out on the 11th of July 2024, we have seen the growth stocks being sold, and that selling pressure came into the market last Thursday and Friday as well. And also what we have seen is a rotation happening in the marketplace. So we have seen the growth stocks being sold, for example, and we have seen really good movements to the upside in the small caps and also the Dow Jones stocks. And I believe it was about 4% that the Nasdaq was down, Nasdaq 100 futures last week. So here we try to understand what is behind the tech sell-off that we have seen. Now on the channel, we take a look at the markets from a technical perspective. So of course we have this big pattern being completed for the Nasdaq 100, and from a technical perspective, yeah, this is one of the reasons that we had this big one-to-one price projection ABCD completed right at the 1.618 expansion of the BC swing, and we have seen a pullback happen in the marketplace last week, and the week before we saw consolidation taking place. So from a technical perspective, yeah, this is a completed pattern. And then we had also seen a similar pattern being completed in the QQQ, which is the ETF for the Nasdaq 100, and of course some of the individual stocks, which we'll take a look at later in the presentation, such as Google and Apple, also completing major patterns. But what I wanted to take a look at was also what could be some of the fundamental reasons why what we are seeing. It's pretty difficult to actually decipher what the participants in the marketplace might be thinking, or what is the kind of data they might be using. So this is why I personally like to take a look at the technicals, because the chart actually and the patterns that form on the chart give us a lot of information. However, I try to actually see what could be some of the other reasons or the elements that we are seeing this kind of a market. We're seeing rotation, and we are also seeing the tech being sold off. And we already know that in the growth stocks, it was actually really a handful of stocks, mainly the MAGA stocks, where we were seeing a lot of money come into. Now, one of the things is possibly that we are seeing the unwind of the carry trade. Now, what is a carry trade? We'll take a look at that in the next slide. But here, what is really important to see and understand is that the Bank of Japan has actually been intervening in the currency markets. And according to Reuters, the Bank of Japan is suspected to have done intervention. And why they are doing this intervention, it is basically to support their currency, which is yen. So if I just read what the Reuters said, Japan is suspected to have intervened in the foreign exchange market to prop up the yen on several occasions this month, underscoring its discomfort over the pain the currency's fall is inflicting on households because of costlier imports. And if you actually Google, you'll also find a similar report happening towards the end of May in 2024, so a few months ago. So the Bank of Japan has actually been really trying to intervene and prop up their currency. Back in the 70s and till early 80s, Japan was the land of the rising sun and was a really export powerhouse. And we really in the industries of electronics and electrical, and of course we know the Japanese cars are really good cars. They're also much cheaper back then, such as the brands Toyota, Lexus, Nissan, Honda. But over the course of so many years, Japan is no longer that sort of an export powerhouse. So usually export is supported by a lower currency, but now they're having to import a lot of things, and especially in a world after the pandemic, where the inflation has raised the cost of a lot of commodities. With a lower currency, it could be difficult, especially when it comes to fuel, for example, the oil prices, which they're having to pay in the yen. And if the currency is lower, then of course it's actually impacting the local market where the consumers are having to pay more. So this is the kind of in the intention they might have. And what the Bank of Japan has already done is, Japan is out of that negative interest rate environment, which they had been for a very long time. So they already tried to do some support for their currency. So what is a carry trade? And based on the Investopedia, a carry trade is a trading strategy that involves borrowing at a low interest rate and investing in an asset that provides a higher rate of return. It is a strategy which is employed by speculators such as hedge funds, for example. So you can read a little bit more about this on Investopedia or Google about it. So what it means is that speculators, for example, they might be borrowing in a currency which is yielding lower interest rates, for example. And if you look around and you look at some of the G7 or the countries or the major currencies, you can see that the Great Britain has pretty high interest rates. Eurozone, although they made a recent rate cut, the interest rates are still elevated. US dollar, for example, in US we have 5% Fed fund rates. But if you look at Japan, their interest rates are pretty low. So what it means is that investors can actually borrow in Japanese yen, and they can invest in higher yielding currencies or other assets such as stocks. And when it comes to stocks, those could be the growth stocks, for example, the mega stocks, the NVDAs of the world, the Apple, for example, or Google, for example. So where they can make a higher return. So that's what is the concept behind the carry trade. So what can Japan do to support their currency, which is the yen? So what they can do is they can actually try to raise the interest rates, but it's going to be very difficult for them to do that. And in fact, the Bank of Japan, Japan was running negative interest rates for a long time, but I believe they are out of that paradigm. They can try to raise dollars, for example, and the majority of the world trade is done in US dollars. Pretty much all the freight movement is in US dollars, so that could be a big help. And how can they do that actually if they were to raise the US dollar? So one of the things is that if we look at the data from Statista, Japan is the largest holder of US treasuries. So here we go. We can look at this chart right here. It used to be China, but now Japan has actually overtaken China with the being the largest holder of US treasuries. So there is a possibility if they need to get hold of the US dollars, they can actually start to dump some of the US treasuries on the market, which could actually, in the short term, we could see the yields actually move higher. But then what could also happen is it will create a lot of supply in the market, and then we are in an environment where, for example, some of the speculators are selling those high growth stocks, and there's money coming out of those. It has to go somewhere, so perhaps those treasuries could be snapped up as well, which could then eventually push the yields lower. But in the short term, we could see a move higher in treasuries. So this is why we really need to carefully watch the treasury markets and the dollar really carefully, and to some extent gold as well, in my opinion. Now, the unwind of the carry trade and lower interest rates. So we think that we are actually slowly but gradually moving towards a environment of lower interest rates. Now, it doesn't mean that we are likely to move towards ultra low rates or even the quantitative easing. What could happen is that we are in the United States at pretty elevated interest rates environment. And if the interest rate environment is likely to remain elevated for longer, then that could have implications for the economy. And this is the recent rhetoric, which is coming from the Federal Reserve Chairman, Mr. Powell. So we'll talk a little bit more about this later on in the presentation. So what could happen is the speculators could begin to unwind the trade as there is a large player which is ready to support the currency. So for example, the Bank of Japan, and if you Google about Bank of Japan, for many years they have been actually supporting or doing interventions in their currency markets. They really look at this thing very closely. And for example, the mega stocks have, these are the kind of stocks in which there has been a lot of concentration on majority of the growth for the indices such as Nasdaq has come from a handful of stocks. So there's a lot of concentration in these. And there is a possibility that as the players begin to move out of MAGA stock, we begin to see a rotation, and which we are already seeing, because we have seen the Russell 2000 move up a lot last Monday, and we have seen a massive rally in the Dow Jones as well, and we have seen the Nasdaq actually being sold off, and also the S&P 500. So there is an element of that rotation going on. Whether the rotation into the small caps, the Russell 2000, is going to be sustained, that needs still some confirmation in my opinion. But again, we are watching these indices on really closely, and I will be updating you guys. So and also there is some rotation happening when the money is, for example, moving out of these MAGA stocks, these growth stocks. It is moving into certain sectors as well. And last week when we looked at the sectors, utilities were something which is actually coming out into the picture. Now, when we look at some of the individual stocks, so for example, Google, we have a completed pattern around here. We have this big A 1-to-1 price projection, ABCD, right at the 1.61 expansion. This is the same pattern as what we have in the Nasdaq 100 futures and also in the QQQ. If we look at Apple, Apple also completed its ABCD, met our target. In fact, we were really bullish around here, 65 level. Now Apple is really interesting because I believe what they have going on. For sure, the stock can actually pull back, but likely to find pretty good support from structure around 200. But we'll discuss this more in our other segment, where we take a look at the key tech stocks. NVDA, and of course another fantastic company, but again it has moved. There's so much movement which has already taken place in this, so it's likely to actually pull back, maybe pull back to 100 around the 20-week moving average. We'll have to wait and see. But these are the kind of stocks where we see sell-off actually also taking a good impact onto these stocks. Then again, on the theme of lower interest rates likely to prevail, we are looking at the chart of Fed fund rates. This is coming from the Board of Governors of the Federal Reserve System. This is actually coming from a system called FRED, where they have fantastic information on this. You can Google and have a look at the amount of research that the Federal Reserve actually does. And there is New York Fed, there's St. Louis Fed. They're putting out really amazing content and a lot of research there. So looking at this, what we are looking at is the chart of Fed fund rates with these gray shaded areas. And what these gray shaded areas represent are recessions. So the last recession that we saw was when the COVID hit. So probably this was the shortest recession in US history. It was over within a few months. And then we have this one when we had the great financial crisis. It was pretty long. We can see by the width of this gray shaded area. And before that, I've gone back about 20-25 years to actually keep things relevant with the modern economy, with the internet and the technology actually having a huge impact on our lives. And then we go back, we see this 2000 to 2002. That was the recession after the dot-com bubble burst. But one thing is really interesting around about all of these points around here, with the exception of this one. When we'll take a look at the financial crisis, the great financial crisis, rates were above 5%, and also in the dot-com era 5%. And where are the rates now? They're also above 5%. So this is something which the Fed actually watches, and they are actually aware of the fact that if the rates remain elevated for longer, and there are actually data points coming from the market where the data is actually softening for which we'll take a look at, such as employment data. And if the rates remain elevated for longer, then that could lead to a recession or hard landing. So they are actually aware of that. And actually there is a chart which is actually really showing that. And we have been here for quite some time. We are flat. So the Fed has not been raising interest rates. And then we have seen this, we have seen flattish around here as well. And when they actually did begin to raise, lower the interest rates, there was a recession. So I think the Fed wants to be more in control and probably aware of the fact that interest rates being higher for longer might not be that good for the economy, especially when the inflation is beginning to fall. Now, if we look at the next chart, this is for the unemployment rate. So we can see this steep rise here since the March reading. And what is indicating is that over the course of the month of April and May and then June, we are seeing a rise in the unemployment rate. So, that could mean a little bit of softening in the labor market. But this chart doesn't tell us a lot, actually. So the next chart that we can take a look at is again coming from the Bureau of Labor Statistics from Federal Reserve, their Fed system. So this is a chart of the job openings to unemployment ratio. Labor markets are in better balance. In fact, they are. If we take a look at what happened pre-pandemic in 2018 and 19, which was pretty strong labor market, and this is where the market is now. Compared to where it was, for example, in 2022. And this is actually a statistic which the Federal Reserve Chairman, Mr. Powell, also made a reference to in the June meeting. So they're actually watching these figures really carefully. Now, what is concerning for me is if you look at this steep decline here, because what this chart is showing is it's actually a ratio. It is the job openings divided by the unemployment ratio. So when there was this steep rise, it means that either there were too many job openings and the unemployment rate was actually falling. So maybe those people were actually finding the jobs. So it kept on rising. And then it began to fall, which is also kind of expected because if the unemployment, for example, if the job openings were getting filled, then there are less job openings coming out. Then if the unemployment rate kind of remains steady or is not moving lower rapidly, we could see a declining path. But it could also mean is that, for example, there is a change in the employment market. For example, the employers are putting out job openings, but they are pulling it back because they might not be able to find the right kind of candidates because they might have either already been taken a job, so they're not able to find those, and then this might be leading to less job openings, for example. And the other one is that maybe the people who are unemployed, they're not able to find the suitable work, and they are just remain unemployed, and this trend might actually be increasing. So we are actually seeing this ratio fall. So in my opinion, Fed is really carefully watching this, and if we begin to see steep declines in here, that is going to be not a good indication, and that could actually be another indicator Fed is watching for a possible rate cut coming, in fact, pretty soon. It could happen. All right. Okay. Now we move to the U.S. dollar. So the U.S. dollar has been persistently strong. It has been a range-bound market, in my opinion, since 2024. Here was the rhetoric for the Fed to cut rates when Fed came out, did a pivot. And then what we have seen is a lower dollar finding support around the 100 mark. And it's been a pretty big trading range. Now, this is coming right from the George Soros book, Alchemy of Finance. And what he mentioned is that when we have a situation when the monetary policy is strong, in other words, the higher interest rate environment, so it's actually tight monetary policy, and we have an expansionary fiscal policy, so taxation is moving lower or there's more spending, for example, then value of the currency is likely to move higher. And this is what we have seen, actually a pretty persistently strong dollar. However, with the anticipation of possible lower rates coming in U.S. Marketplace, Fed cutting the rates, that could have an impact on the US dollar, and the US dollar could actually begin to move lower. And this is what our perspective is as well. And on the daily chart, we were watching for this black ABCD to complete around a little below 103 level. However, some support has come in around the 103.50 level. So that would actually also begin to help the Bank of Japan. In other words, for example, if the US dollar begins to weaken, then the yen is actually going to strengthen. So really interesting situation. And if we take a look at on the weekly chart, we can see that it just found support right from the 6th of June candle right here. So that actually still brings a possibility, although an unlikely scenario in my opinion, because I personally think 107 is a very strong top. We have seen a top, double top, and a double top formation around here. But as an alternative scenario, a rise to about 108, maybe a 108.50 is the kind of, level that we can think about. So I'm still putting it on the table, but the chances are that US dollar is likely to move lower, at least what I think longer term. So this is a really long-term chart. This is a quarterly chart. We have this market symmetry concept here. The market went from in the 1990s, early 1990s to around early 2000s, went up for about 10 years, and it declined for about 6-7 years, and then the US dollar has been in a bull market, especially taking effect from 2011. Now we have certain patterns that are completing. It has taken about 12 years for the dollar to make that high, which is around this point D here. So my opinion is that, the dollar might have actually peaked. However, it doesn't mean that it cannot rally, because here, when we look at this area here, there have been some fantastic rallies. So there's a chance maybe the dollar could actually rally, maybe make a slightly higher high. But ultimately, if it begins to move below 99, and then chances are it's going to go much lower and at least test these lows around point C. So really interesting perspective for US dollar. Lower US dollar longer term is actually favored. Then we take a look at the US 2-year notes. Now, what we think is that we are in this black ABCD, and the treasuries are likely to see, especially the 2-year note, yield up to 3.9%. That's what we are thinking. However, we had this trend line. The market broke below this after breaking the 4.7, which is pretty strong support for quite some time, right at the 38.2%. And what we have a situation is called a throwover, because the yield has actually moved above the trend line. And if it persists here, it's a little bit of concern for me, because the yields could rally. It means that real yields could rally, and I think it could rally to about 4.65%. What it means is the risky assets such as stocks could be under pressure. So a rise in yields, firm dollar is putting pressure on stocks. So we are seeing a sell-off as well. Now, if we take a look at the 10-year Treasury note, a case perhaps could be made that the bear market might actually be coming to an end, but we need to see more evidence. And the chances are we are in this ABCD higher. Actually, that's my preferred scenario, but the market is finding a fair amount of resistance over the course of last 2 to 3 trading days. And if this scenario we spoke about with the Bank of Japan, if Japan is going to actually sell some of its treasury stock, and then this market could actually come under a lot of pressure. So this is why we are really carefully watching the treasury markets and also the US dollar. Preferred scenario, we're in the CD leg higher, a fair amount of resistance coming in right from the 61.8% retracement. So we have to be careful. And this is the weekly chart for the 10-year Treasury note. And then we take a look at the long-term long bond futures. This is the weekly chart. It found really nice support for, I believe it's a daily chart, might have written it wrong, so you excuse me. Found really good support whenever it came under pressure, and just consolidating around here. It's just like the 10-year. I think that this is in this ABCD higher. Could see 132 on this chart. But remains under pressure last week. And this is a TLT weekly chart, a similar kind of pattern to long bond futures. Now, really interesting, we begin to move towards rotation. So what we have seen is in the US stocks. This is as of close of the last week, so the week which began on 15th of July, trading week. We have seen the S&P 500 E-mini futures down about 2%, Nasdaq 100 futures down about 4%, and the Dow Jones futures up about 0.5%. And the winner is really Russell 2000, which is 1.71%. So you look at this and you know what is happening around here, and this has been the topic of this presentation. Try to understand, what might be happening. So there are several aspects to it, but ultimately, what it points to is that we have a rotation happening in the market. So this is leading to sell-off in certain kind of stocks, certain kind of indices which are heavy in certain kind of stocks, which are mainly growth stocks. We are seeing money moving out of those. We are seeing money moving into other kind of stocks, such as Dow-related stocks, especially small caps, which in my opinion we still need to see more evidence for sustained rally. Although it is being very close to the kind of the pattern that we were watching for. That's a topic for tomorrow's video, so I will not go too much deep into it right now. So that's our kind of the scenario or the evidence that we have seen in terms of market's price action, closing basis for the week, for rotation. Another chart which I shared last week, really interesting one. This is the ratio of the SOX, which is SOX, which is Semiconductors Index, and the Gold Bucks Index. Last time we had seen a high come into year 2000, so 24 years later, we have the market reaching pretty much a similar level, but not quite there. And what is really interesting was also around the time when the gold, the underlying commodity, was starting its bull market, whereas now the gold market is actually pretty high or elevated already. Another interesting thing was in the year 2000 we had the internet and the dot-com era, and the Fed fund rates were above 5%. Now we have the blockchain and the artificial intelligence era, and the Fed fund rates are also above 5%. But what this chart is representing is that around here there was a rotation, a possible rotation which happened where the money started to flow out of these high growth stocks, and some of these stocks which were perhaps really depressed, such as the gold miners, money started to move into it. And then it took quite a while. It didn't happen straight away, quite a while, but this is where things began to go really interesting in around 2011 time, that we began to see this actually this ratio go up, beginning to move up higher. So meaning that growth stocks began to really accelerate again. So there came a time when these really depressed stocks actually they began to outperform the growth stocks. And we don't have much evidence here, but this chart is really very, very interesting. What it is pointing to is that perhaps if the money is going to come out of the growth, then some of these gold miners, silver miners, and gold royalty stocks are really depressed in their price, and these kind of depressed stocks might also begin to see some life come into them, and that could actually perform pretty well and give pretty good ROI in terms of a percentage. So really interesting one to take a look at. And then we have this chart which I just labeled as 2 sigma. So on weekly basis I give out standard deviation levels. So I recalculated the standard deviation levels for the Nasdaq 100 futures using a different index. Normally I've been using VIX, but VIX is more excuse me, for S&P 500 E-mini futures. This one is for the Nasdaq, so I think it's more accurate to use this one. And based on this, we get a slightly different -2 standard deviation level, which the market did not reach exactly, but came pretty close. Definitely, market went between -1 and -2 standard deviation levels, and we also have 38.2% retracement, really close to the -2 standard deviation level for the last week. Things will change. We'll have a newer calculation, which I'll give out in tomorrow's video. So here what we see in this blue chart is actually the normal distribution curve. This is something most of us will have come across in our elementary school statistics. And here what we have is, if we just count all the probabilities from here, we get to this one here. We get about 84%, and that gives us a percentile. So what happens is that 84% of the time the market is actually moving in this +1 or even -1 standard deviations, and that's kind of a 84% chance what the market is doing. But it really gets interesting when we begin to actually move out of that and we begin to move in this pocket around here, and this is what the market did last week. So what does it mean if the market actually hits two standard deviation levels? So in the last 18 months, there have been three occasions when that happened. It happened on the 5th of January 2024, hit the -2 standard deviation level, 19th of April, -2 standard deviation level, and 31st of May, -2 standard deviation level for the weekly ranges, right? And for the 5th of January 1, the market actually rallied for about 14% and about 10 weeks in duration. And then when it happened on the 19th of April 2024, market rallied about 10%, about 78%, 78 weeks. And then we had the recent one, 31st of May, and the market actually rallied about 15%, 14% for a duration of about 10 weeks. And look, there is also the 61.8% right here with respect to these lows, 38.2% with respect to these lows. These are pretty strong markets when it finds support from 38.2%. And last week, the market actually did not get exactly to the -2 standard deviation level, where we also have the 38.2% retracement, but the market is down a fair amount starting from the 11th of July. So what does it mean? If the market is actually going to hit these levels, then we have to be watching this, because what this pattern or the history, which doesn't repeat itself but does rhyme, is telling us that the market had actually rallied on those occasions that had hit the -2 standard deviation levels. So we'll be really keeping a keen eye on these for the next week. We'll have different levels though. But if it doesn't, and it doesn't do it, and it breaks through these levels, that is a direct market feedback coming in that perhaps something has changed, and that change could be CIT, i.e. change in trend. So really critical week coming up for the tech stocks in particular. Next week, the S&P 500 did not do this exact. It was pretty weak as well, but it didn't come as close to the -2 standard deviation levels. So this is why we really like to keep an eye on these standard deviation levels, particularly the weekly levels, and this is why I give these out in the weekly videos in advance, so that we are aware of what to watch. So again, I would like to thank you guys for watching the presentation. And if you found this video of educational value, then please do subscribe to the channel. And if you do, then please hit that bell icon button. That way you will know when the new videos are posted. And I will be back tomorrow with another presentation where we'll actually do more technical analysis work on the indices that we are watching. So thank you very, very much for watching the video. Good luck, good trading, and speak to you guys soon.